So you're thinking about investing in Indian banks. You've got HDFC, SBI, ICICI, Bank of Baroda. Where do you even start? It can feel a little overwhelming, right? Well, what if I told you there's one key signal, one single metric that cuts through all the noise? Stick around because today we're going to build a simple toolkit to find the clearest sign of long-term success in the Indian banking sector. Hi friends, welcome back to Murthy Finance Academy. All right, let's jump right in. Here's what we've got on the agenda today. First up, we'll talk about why Indian banks are such a hot topic right now. Then I'm going to give you a super simple 3-metric toolkit, your new best friend for analyzing any bank. After that, it's showdown time. We'll pit private banks against public sector banks. We'll also uncover a really interesting difference in their core strategies, look at what's coming down the road, both good and bad, and finally, we'll answer the big question: what is the one signal that matters most? So why are we talking about Indian banks right now? Well, because the entire sector is at this really pivotal, exciting moment. After some tough years, the skies are clearing, and for investors who know what to look for, the opportunity is absolutely huge. It really comes down to 3 big things. First, the cleanup is done. For years, bad loans were a major problem, but now the balance sheets are probably the cleanest they've been in a decade. Second, you've got global investors showing real confidence, not just for a quick flip, but for the long haul. And third, and this is the big one, there's just so much room to grow. Getting everyone a bank account was just the start. The real growth wave is in lending, and that's just getting going. And if you want proof of that cleanup, just look at this number. Gross non-performing assets, that's just a fancy term for bad loans, have plunged from a scary 11.2% all the way down to a very manageable 2.2% today. You know, this isn't just a data point. It's the story of a system that has healed itself. It's disciplined, it's stronger, and it's ready to grow. Okay, so now we know why we should be looking at banks. Next, let's build your toolkit so you know what to look for. Forget all the complicated financial jargon. I'm going to show you 3 simple, powerful metrics that will let you analyze any bank just like a pro. It's a really simple 3-step check. First, we'll look at how profitable the bank is using something called net interest margin. Second, we'll check the real risk on their books with net non-performing assets. And third, we'll measure how lean and mean their operation is with the cost-to-income ratio. That's it: profit, risk, and efficiency. So, what on earth is net interest margin, or NIM? It's actually super simple. It's the absolute core of what a bank does. A bank makes money on the interest from loans it gives out, and it pays you interest on the deposits you keep there. NIM is just the difference between the two. A healthy NIM means the bank's main engine is running well. Next up, net NPA. Now, you hear a lot about gross NPA, which is just the total amount of bad loans. But smart investors, we look at net NPA. Why? Because banks aren't caught by surprise. They actually set aside money for loans they expect to go bad. That's called a provision. Net NPA is the value of bad loans after you subtract that rainy day fund. It's the truest measure of stress on a bank's balance sheet. And last but not least, my personal favorite, the cost-to-income ratio. I love this one because it's so direct. It's the ultimate efficiency test. It answers a simple question. To earn 100 rupees, how many rupees does this bank have to spend on salaries, rent, tech, the whole shebang? Of course, the lower this number is, the better. It's a direct peek into how well the bank is being run. All right, got your toolkit ready? Let's put it to the test. It is time for the main event. The private sector champs, HDFC and ICICI, versus the public sector giants, SBI and Bank of Baroda. Let's let the numbers do the talking. And this is where it gets really interesting. Take a look. On our first 2 metrics, NIM and net NPA, things are actually pretty close. The PSU banks, like SBI, have done a phenomenal job cleaning up their act. But then your eyes drift down to that 3rd row, cost to income. And wow, you see a real gap open up. HDFC and ICICI are humming along at about 39–40%, while SBI and BoB are closer to 50%. A very clear difference emerges. This chart just makes that gap impossible to ignore. For every 100 rupees they earn, the private banks are spending about 40. The PSUs, they're spending nearly 50. Now, that might not sound like a huge difference, but at their scale, that 10 rupee gap is massive. It shows you that right now, the private banks are just more efficient machines at converting their operations into actual profit. But you know, it's not just about efficiency. There's a deeper, almost philosophical difference in how these banks think. And we can see it really clearly if we look at one last idea, something called the statutory liquidity ratio, or SLR. Here's the deal. The central bank requires every bank to keep 18% of its funds in super safe government bonds. Private banks basically treat this 18% like a minimum requirement. They meet it, and then they use every other rupee they can to give out loans and earn higher returns. But the PSUs take a safety-first approach. They hold more than the minimum, maybe 21 or 22%. It's a fundamental choice. PSUs prioritize stability, while private banks are designed to maximize returns. So that gives us a really clear picture of where things stand today. But we're investors, right? We have to look down the road. So what's going to drive growth from here, and what are the potholes we need to watch out for? The biggest growth story, by far, is right here. This chart shows the credit to GDP ratio. It's basically how much money banks are lending compared to the size of the whole economy. In India, it's only around 56%. In a lot of other developed Asian countries, it's over 100%. What this tells you is incredible. There is a massive, multi-year runway for Indian banks to grow just by serving the natural growth of the economy. Of course, it's not all smooth sailing. Every investment has risks, and here are the 3 big ones to keep an eye on. First, some people are getting worried about unsecured loans. Think personal loans and credit cards. Second, loans are growing faster than deposits, which could create a funding squeeze down the line. And third, if interest rates start falling, it could put pressure on those margins we talked about. A smart investor always keeps one eye on the road ahead and one on the rearview mirror. And that brings us to the final and, I think, most important part of our analysis today. We've gone through the profits, the risks, the efficiency, the strategies, and the future. So let's bring it all home. What is the single clearest signal for a long-term investor like you? So let's just ask the question directly. With margins pretty stable across the board and the bad loan problem largely fixed, which one of our 3 tools, NIM, net NPAs, or cost to income, is going to give us the best clue about which banks will outperform in the long run? And the answer, the clearest signal you can find today, is efficiency. Think about it. The battle for survival, the war against bad loans, that's largely over. The new battleground is all about execution, and the cost-to-income ratio, that's the ultimate report card. It tells you in black and white which management team is running the tightest ship, which bank is the most disciplined machine for generating profit. So here's the big takeaway. The banks that are going to be long-term winners aren't just the ones that grow the fastest. They'll be the ones that master this tricky 3-part balancing act, finding quality growth, keeping a firm grip on risk, and, this is the key for the next few years, operating with absolute efficiency. The banks that can nail that combination are the ones to watch. If you like the video, please like, share, and subscribe to Murti Finance Academy.